Inevitably, with that coverage and with that membership, what we're focused on is the last 5 years as well as the near term for the future. So EMIR, MiFID II, CRD4, REMIT, and others, they're all smack within our members' sweet spot. So looking forward, as we think about jobs and growth, we need to make sure that we find a way to avoid falling behind the US as it accelerates its economy with its imminent increase in interest rates, and we avoid falling behind Asia. China has its challenges right now, but longer term, the growth prospects are clearly there. And Asia regulators and governments have their arms wide open to Europeans who wish to migrate their business east. So the job for Europe is to keep Europe's business in Europe. Looking back, the call for evidence yesterday was a very welcome development. It is important that thanks to the European Commission's better regulation agenda, we keep checking how we're going as we go along in that car that's shuttling along at 12 miles an hour or 200, depending on your view. With perhaps a bit of a crystal ball, FIA Europe actually published a paper entitled A Review of the Cumulative Effects of EU Derivatives Law Reform back in June. So in many ways, we've already drafted the response to yesterday's call for evidence. And we have been providing a lot of data to the Leverage Working Group at the Basel Committee about the impact of the leverage ratio on access to clearing under EMIR. And we look forward to providing that data to the European Commission as part of this call for evidence. The statements from earlier speakers are quite right. This isn't an opportunity to tear up what has been done over the last 5 years. This is an opportunity to fine-tune and calibrate accurately the regulations that have been put in place over recent years and that are upcoming. This week we also saw the proposals for market abuse for MiFID II and CSDR. They're all on the right track. They all evidence ESMA having listened to industry feedback largely. It's not to say there aren't still some issues, there are, but there is clear evidence of better regulation working at the ESMA level as well as the European Commission. So what are the issues? As I mentioned in my question to the panel earlier, part of it is about the right calibration, about getting regulatory capital rules to support the objectives of markets regulators. And for that, we need to look at the leverage ratio calibration. We need to look again at the extent of application of CRD4 to commodity traders, energy companies, and market makers, and the impact that that might have in particular on jobs and growth as those people sit squarely in the real economy and are being subject to significant increase in costs. One of the other major challenges, apart from regulatory capital, is conflicting insolvency laws. This is one of the hardest things, along with taxation, to fix at a European level. It is important and an important aspect of the Capital Markets Union as we look to reduce the barriers to cross-border investment. It's also important in the context of EMIR and MiFIR as we look at some of the legal challenges to indirect clearing, both for swaps and for exchange-traded derivatives. And a lack of harmonisation of insolvency law and a lack of appreciation in the regulation for third country insolvency law are one of the key reasons why indirect clearing is not a success so far. The reduction in liquidity is a concern. I was reading a paper this morning that suggested that all this commentary about a drop-off in liquidity is just the industry's clever ruse to get more lax regulation. Couldn't be further from the truth. The risk of a drop-off in liquidity is a structural issue, in part driven in particular by the prudential rules. I can talk about that in more detail on the panel. So capital rules are definitely key. Harmonisation of insolvency law will certainly help the Commission's objectives. What are the other issues? I don't know if it's possible to click on to the next slide here. Thank you very much. There's only one of them. Oh, sorry, apologies, I've gone back. As I say, before we go too far forwards, we also need to look backwards, and the call for evidence will help us do that. Where are the challenges? Well, as we were just hearing, we do need to look at a national level, at a European level, and at a regional level, by which I take that to mean third country laws. We need to ensure that there are granular international standards by the standard setters that are capable of equal and equivalent implementation in practice at a European, US, and other regional level. And that will really help equivalence discussions. We also need to address inconsistent member state insolvency and property laws for the CMU and indirect clearing issues I mentioned earlier. EMIR, so access to clearing through intermediaries, i.e. clearing brokers, they need to be there. They are subject to the leverage ratio. The leverage ratio essentially just creates a finite capacity on investment banks to provide access for the end users to clearing. There's a finite limit. Some of the top 10 brokers have already hit their limit. So with new clients, it's a case of one in, one out. That's a problem when you look at access to clearing, and that's why you're quite right that Kostas mentioned that the FSB and others are looking at whether we've got the leverage ratio right in its calibration, or whether we're going to see a continued shrinkage in the clearing broker community, which is reducing choice, reducing access, and reducing competition potentially amongst clearing brokers, none of which are consistent with the regulatory objectives of EMIR. Capital Markets Union and CRD4. So on the one hand, we want jobs and growth. On the other hand, with the regulatory capital impositions on some of the people I mentioned before, the energy companies, the market makers in particular, that make up 40% of the market, are those two compatible? Again, is Capital Markets Union and financial transaction tax compatible? Wouldn't seem so at first blush. Reporting and transparency have been a key feature both of EMIR, of REMIT, of MiFID II, of AIFMD, and countless other regulations. Part of the problem is they're in so many different regulations. So are regulators receiving the reports that they need? Yes, but there are issues with the data. That issue with the data is at the heart of whether regulators are willing to contemplate the move from today's dual-sided regime under EMIR to a single-sided regime under EMIR, as the industry would prefer. Getting the thresholds is right. We've heard a lot at the Eurofee conference a couple of weeks ago in Luxembourg about the importance of getting the thresholds right for bond transparency in the context of Capital Markets Union. The IBEA approach is to be welcomed. It's not only, though, about transparency, it's about ancillary activities. Getting that threshold right in MiFIR is critical, because by bringing people into scope to MiFID II, as you know, you also get them in scope for CRD4. Costs go up, increase in the real economy costs. Then you need different products, they need different rules. You can't just lump exchange-traded derivatives all in one bucket and OTC derivatives all in one bucket. Commodities come in many different shapes and flavors. You can't just say all commodities are the same. Periodic reviews and addressing unintended consequences is critical. That's why we welcome this call for evidence from the European Commission. It's a great improvement to see that desire to get the balance right. That's all looking backwards. This panel is supposed to be about future challenges, so I won't let that opportunity to go by either. So finally, as we think about future challenges, we have clearinghouse recovery and resolution proposals coming from the European Commission just this side of Christmas, we understand. I look forward to engaging with the European Commission and others on that. The Volkswagen incident of recent days has really highlighted something that the UK is already at the forefront of when it comes to bank regulation, which, as Nigel Wilson was talking about earlier, is conduct and responsibility. And this has very much been seen as a financial services thing, a thing for banks, a thing for asset managers, a thing for shadow banking. But what VW shows is actually it needs to be about commodities, it needs to be about corporates, i.e. the market at large. So we can expect, I think, an expansion of the conduct and responsibility legislation to an ever wider range of participants. We also heard from Nigel about the need for the industry to go digital. Couldn't agree more. We can therefore anticipate regulations relating to cyber security. With MiFID II, there are a handful of small provisions about penetration testing, making sure that those who provide access to trading venues and clearing houses have resilient and robust systems. Those market infrastructure firms that we rely on so much must also have sufficient cybersecurity, but we don't yet have specific cybersecurity regulation. Technology moves on so fast, it's very difficult to set that out in detail, but perhaps we can envisage some high-level principles that are agreed on a global basis at some point in the near future. If Blythe Masters is to be believed, blockchain is the future of financial markets. The problem for blockchain technology is that it does not respect geography. It does not, therefore, respect national borders and, therefore, legal jurisdiction. It is, therefore, very hard to legislate for blockchain technology. So, as you said, we need global standards that are granular. They need to work at a national, EU, and regional level. I don't think there are wholesale changes that are needed to today's regulation in the derivative sphere, but there's plenty of fine-tuning that can and must be done. We've got to get the capital calibration right. We should fix some of the obvious insolvency issues. And it is critical that whilst there's a lot of noise at the moment about the potential drop-off in liquidity, that we take that as seriously as the subject needs. I don't think the industry has done enough yet to explain why liquidity is as important as it is, and we look forward to continuing that discussion in the near future.